Okay, folks, we're going to get started in about a minute. So if you'd all have a seat, sorry, normally we have a banker's breakfast, and I know you folks show up early. There's no bacon, there's no sausages or eggs, but we do have a great presentation for you. So just take a seat, and we'll be with you in one moment. Okay, so good afternoon. Welcome. This is a beautiful day once again. A little windy, but great day. And welcome to the Banker's Business Update, helping clients navigate the COVID-19 recovery period. It's May 4th, 2020. And this presentation is specifically geared towards you bankers who we love so well. So welcome. This is our slide telling you that the information that we're providing is for general guidance only, and it doesn't constitute the provision of legal advice, tax advice, accounting service, investment advice, or professional consulting of any kind. And if you bankers really need the advice, well, then please see your professional advisor so you can provide them with the specific and pertinent facts relevant to your particular situation. Today's agenda, introduction, which is what we're doing right now, tax credits, incentives, and deferrals. That's a mouthful. Main Street Lending Program, the Main Street New Loan Facility, the Main Street Expanded Loan Facility, the PPP Certification Requirements, SBA FAQ number 31. That's a very interesting and well talked about topic. Loan forgiveness, and then also we're going to have a very lively open discussion. And here is your panel today: myself, Todd Polinak, my partner Josh Shanani, and Stephen. We're going to present to you some really wonderful topics. By the way, a shout out to Governor Murphy, who opened up the golf courses this weekend. I was able to play this morning, very happy. My dog Banksy is very happy that he also opened up the dog groomers. We are all looking forward to him opening up the opportunity to go to the barber and also the hair salon, because we're all looking like bohemians. So our hairstyles are not quite the same as in these pictures, but we're hoping to get back to normal someday soon. We're going to kick it off with my partner, Steve, who's going to talk about tax credits, incentives, and deferrals. Steve, take it away.
Thank you, Todd. Good afternoon, everyone. Hope everyone is staying safe and healthy and doing well. So what we're going to talk about here are just the tax credits, incentive, and deferral opportunities specific to a certain number of items. They're really, as part of the CARES Act, there was a number of tax incentives, NOL carrybacks, interest limitation free-ups. We're not going to go into that. We're just going to speak today specifically about a few items that may be of interest to you. The first one here is part of 2302, section 2302 of the CARES Act, allowing for a deferral of the employer portion of the Social Security taxes due on wages incurred between March 27th, 2020 and end of this year. Eligible taxpayers are able to defer 1/2 of these payments until December of 2021, with the other half paid the following year on New Year's Eve. However, the piece that's important and what we're going to emphasize here is that understanding how these credits and incentives work and how they interact and impact other items of the PPP program and other areas is integral when discussing this with clients. But once an employer receives a decision that its PPP loan is forgiven, they are no longer eligible to defer these deposits. However, the amount deferred until that date can be paid by the applicable dates being the dates referenced above, 12/31/21 and 12/31/2022. So that's something to keep in mind. The IRS has also issued a pretty significant, pretty helpful Q&A if you want to go on irs.gov to understand that. But this is essentially the impact of the payroll tax deferral. Next slide, please. In addition to the deferral, there is a employer retention credit for certain eligible employees. That's part of Section 2301 of the CARES Act. And this is basically a 50% credit on 10,000, the first 10,000 of qualified wages paid to employees. So it's capped at $5,000 per employee, but it could be significant depending upon your employee base. And it's for wages paid or incurred between March 13th, 2020 and the end of this year. And eligibility is basically determined by a full or partial suspension of operations by a coronavirus-related governmental order, or a greater than 50% decline in gross receipts as compared to the prior quarter in the same year. So if you do go through that reduction once that quarter ends, then your ability to claim the credit ceases as well. Qualified wages, as referenced above, are dependent upon employer size, and basically employers with greater than 100 full-time employees, the credit is only available if those employees are not providing services. So employer size does have an impact here. All others, it's anything basically paid to an employer where the coronavirus impact still exists. Here, where it's important, as we were saying, the interplay between the different incentives, but recipients of PPP loans are not eligible to take this credit. So that's something to keep in mind. If you've received a PPP loan already, it's too late, but businesses that are still considering, and not all applications are in, they're not eligible to do both. And also any employee for which the employer is allowed to take a work opportunity credit. That's what the WOTC is. You claim the credit by reducing your payroll tax deposits on your 941. The IRS recently issued the updated 941, the form that's the form you do your quarterly payroll taxes on. But if your credit exceeds that amount, you can submit a Form 7200, which is a new form that lets employers get an advance refund of these credits. So something that's beneficial from a cash flow perspective. And lastly, the wages here are excluded under the Families First Coronavirus Response Act, which was the first phase of the relief that's been offered. We've had really 3.5 phases if you consider the second round of PPP funding as CARES 2 or CARES 3.5. But what is the Families First Coronavirus Response Act? Well, that basically applies to employers with fewer than 500 employees. They are now required to pay paid sick leave and emergency family and medical leave. Now, employers with 50 or less employees, there are certain small business exemptions, but these are very hard to fall under. So if you have clients considering those, I would point them to legal counsel and discuss that with their advisors as well. This is for wages paid from April 1st, 2020 through the end of the year, and the credit ranges, the sick leave ranges from $2,000 to $5,110. It's between $200 and $511 per day times 10 under the Sick Leave Act, and does not exceed $10,000 per employee under the Emergency and Family Medical Leave. So that's the wages that you're allowed to pay people who meet certain criterion. There's 5 lists of criterion which aren't mentioned here, but it's depending upon if you're unable to work, or if you're taking care of somebody who's unable to work or can't work because your child isn't allowed to go to school, then there are some sick leave and emergency family and medical leave wages that can be paid. The employer is entitled to a refundable credit of 100% of these payments, plus qualified health expenses, as well as employer side Medicare tax. And similar to the employer retention credit, this is also claimed on 941 or using a Form 7200, essentially getting the advance payment. However, these wages are excluded from payroll costs under the PPP. Now, that doesn't mean you're ineligible for the PPP if you pay these wages. It's just that from a payroll cost perspective, you're unable to claim both. So the overall theme here, and there's a lot of information, being that there's an interplay here between the PPP loans and some of these tax credits, incentives, deferral opportunities. That's something borrowers are going to want to keep in mind. So to the extent you can educate them, or at least point these facts out to them, it would be beneficial. Okay, switching gears for a second here, something that has received quite a bit of press for certain borrowers is the Main Street Lending Program. And as we said, we are attempting to keep this as current as possible. The introduction slide actually mentioned just two of the loan facilities, but there's actually been a third loan facility, the Main Street Priority Loan Facility, which we'll cover again, or we'll cover as part of this, but just wanted to keep that in mind as well. Just a little history of this, if you will. About a month ago or so, on April 9th, the Federal Reserve took a historic $2.3 trillion action. A new guidance was made available just last week, but the overall $2.3 trillion package was aimed at households, small to mid-sized businesses, and state and local governments, essentially looking for ways to add liquidity to our environment, to the economic environment, as companies look to rebound, or as people, individuals are suffering through this unfortunate pandemic. And as I said, while updated guidance was released just last week, the actual launch date of this program is TBD. Our understanding is that it'll be early May, but whereas the PPP and the EIDL were done, the PPP being done through the bank, but ultimately administered by the SBA, and the EIDL, the Economic Injury Disaster Loan Program, being directly administered by the SBA, this is administered by the Federal Reserve. And applicants, at least if the rules stick as they are, will be applying to respective banks. So this is definitely something you as bankers are going to want to get educated on, which is why we're having the discussion. I would like to point your attention to the handouts that you'll see on your screen. There's a list of FAQs, and it's more than just questions. There's actually some pretty good answers. It's about a 19-page document, and I think it's written where the language is not too thick and dense, where it could be understood and kind of read through. And there's certain areas of this you'll definitely want to get yourself familiar with. And we have also included in the handout section term sheets associated with these three loan facilities, because these provide a good summary in terms of what the loan details are. From an overview perspective, borrowers will be able to use one, but not all of these facilities. Now, it doesn't mean you can't use the same facility over and over again. We'll see if there's additional guidance, but as of now, you can technically get loans under the same program, provided you don't exceed the maximum amount of the loan vehicle, which we'll go through in a minute. As I was mentioning, this is part of the Federal Reserve and therefore authorized under Section 13(3) of the Federal Reserve Act. Essentially, the Federal Reserve Bank of Boston will lend to a single SPV, single special purpose vehicle on a recourse basis. So the SPV will participate 95% in the Main Street New Loan Facility and Main Street Expanded Loan Facility, but only 85% in the Main Street Priority Loan Facility. So that puts the rest essentially on the bank. So as part of the process, you're going to want to be looking at the creditworthiness of the applicants. And the Treasury Department has also invested $75 billion in equity into this as well. So that's where their piece of the hook comes. But this overall package is $600 billion. But the single purpose vehicle will cease purchasing loan participations on September 30th, 2020. At least that's how it's written right now. As I was saying, there's $600 billion in funds committed to this program, which certainly seems like a great deal of money. But as we saw from the PPP, that money goes fast. So the Federal Reserve and the Treasury may adjust the size, the length, overall measures. We'll see, because when we get to it, we'll see which businesses are eligible and which are not. Figured this would be of interest. Lender eligibility requirements, they expanded it. Banks, savings associations, credit unions, as well as U.S. branches or agencies of foreign bank holding companies, savings and loans, subsidiaries, intermediate holding companies of foreign banks. So it seems like from a lender perspective, there's a lot of opportunity to get in front of clients and help them out. And banks will be expected to conduct an assessment of each potential borrower's financial position as part of the application process. So there will be some responsibilities for the bank to make sure that the borrowers do indeed meet the eligibility requirements. And this may be more meaningful to you as bankers than us as accountants, but depending upon which program you're under, you have to have an internal risk rating equivalent of pass. So that's something that talks about the ability for the borrower to repay the loan. So it's just something to keep in mind as well as you're making the assessment. And again, we expect more detailed guidance from the Federal Reserve and Treasury as to how that works. From a borrower perspective, we've listed the eligibility requirements here as well, and they've been loosened a little bit. Namely, it's now for businesses that were established prior to the 13th of March of this year. They're not ineligible businesses, which we'll discuss. And one of the new items, the initial launch had 10,000 or fewer employees, or $2.5 billion or less in 2019 annual revenues. And that's actually been increased, as you see here, to 15,000 or fewer employees, or $5 billion or less in 2019 annual revenues. And that can be measured via GAAP financial statements, or if GAAP financial statements aren't available, receipts. So that's a pretty significant threshold, and hopefully borrowers that are indeed in need of funding will fall under that threshold as well. The businesses have to essentially be US based, created or organized in the US or under the US laws, with significant operations and a majority of employees in the US. And as I was saying, you can only participate in one of the 3 Main Street facilities. And there's another separate facility as part of this $2.3 trillion action called the Primary Market Corporate Credit Facility, which was a facility essentially that purchased eligible corporate bonds and certain syndicated loans and backed them. You can't participate in both of those as well. And also, you could not have received support pursuant to the Coronavirus Economic Stabilization Act of 2020, which is part of Title IV of the CARES Act. PPP loans are actually part of a separate title and are thus not included in Title IV. And therefore, recipients of the PPP funding are eligible, and I want to repeat that, are eligible to participate in this program as well. And lastly, they're saying you need to make a commercially reasonable effort to maintain payroll and retain employees. Prior and in the CARES Act, there's specific thresholds that are referenced, but this is taking a bit of a looser interpretation of that and just basically making an effort to maintain payroll, retain your employees. One of the interesting aspects of this in terms of an eligibility perspective is that only for-profit businesses as of now are eligible. Not-for-profit entities are not. And the rules talk about being organized as a partnership, a corporation, association, a trust, an LLC. And it doesn't mention whether a single member LLC falls in that. That doesn't have employees, so we will see tribal businesses as well, joint ventures, provided they don't have a certain level of foreign investment. So that's something to keep in mind as well in terms of borrower eligibility. In addition to that factor, certain businesses, as part of Title 13, Section 120.110 of the Code of Federal Regulations, they're ineligible as well. Similar to the PPP program, these are certain types of passive businesses. These are your gambling institutions, life insurance companies, private clubs, any business engaged in illegal activity. Take a look if you're interested exactly what these sections are. There's a number of them listed here: lobbying, speculative. So there's a number. We didn't want to list them all, but certain businesses are not going to be eligible. So just keep that in mind as well from an overall borrower eligibility perspective. We did want to provide you with this chart. It's in the guidance. If you happen to look at this, it's also in the FAQ, but this just gives the overall specifics in terms of who can and cannot apply and what the loan size will be. And the new loan facility and the priority loan is for secured or unsecured term loans originated after 24th, whereas the expanded loan facility, which essentially upsizes an existing loan, is for secured or unsecured loans originated on or before April 4th, 2020 that have at least 18 months of maturity remaining. You'll see here that the term is 4 years. There is a 1-year deferral available, so you don't start making payments until years 2 through 4. The minimum loan size is between $500,000 for the new and priority loans and $10 million for the expanded loan. So you see obviously the expanded loan size is much larger. The maximum loan size is based upon a computation here, basically the lesser of 25 million or a multiple of EBITDA for the new loan and priority loans, and the lesser of 200 million, 35% of outstanding and undrawn unavailable debt are an EBITDA multiplier. And you'll see outstanding and undrawn available debt is just basically undrawn loans, undrawn lines of credit. It's detailed specifically in FAQs. But the maximum loan size for new loans and priority loans also has an outstanding and undrawn available debt factor that goes into the calculation as well. So you have to couple that with your EBITDA calculation when you're looking at this. And just so you know, from an EBITDA perspective, this is computed exactly how EBITDA would have been computed normally. So there will be no real modifications other than how you had computed it before. We were talking about the risk retention here, so 15% for the priority loans, so more risk goes along with those loans as well, but you'll see there's different characteristics as well. And one of the new features of this, compared to the April 9th, 2020, the rate is LIBOR plus 3%. The prior guidance issued basically said it was going to be the standard overnight federal rate plus between 2.5% and 4%, and they've changed this to be more LIBOR based. So something to keep in mind there as well. Other details, there's no prepayment penalties, so these can be paid off. And something that may be of interest to you as the bankers here are the fees that you can charge to the borrower that you'll be charged from the single purpose vehicle, or the special purpose vehicle. So there's a transaction fee and a loan origination or upsizing fee. And that you'll see that the special purpose vehicle pays fees to the lender in this instance from the origination or upsizing perspective as well. And lastly, the loans may be secured or unsecured, but the upsized tranche in the expanded loan facility must be secured if the underlying loan is secured. So again, something to keep in mind. There's a lot of details here in terms of the requirements, so you're going to want to make yourself familiar with these, but we're here to answer any questions if you happen to have. So as part of these programs, and don't you just love these abbreviations, but there are certain lender and borrower attestation and certification requirements that must be made, and you'll see that they're similar between what the lender and the borrower has to attest to or certify. But this is essentially saying that from the lender's perspective, it won't ask the borrower to repay debt expended to the eligible borrower, pay interest until this is paid at first. So it basically takes a prioritization, unless it's mandatory and due or a default or some sort of acceleration. So there is a little bit more wiggle room here. You'll see other attestations, including the lenders will commit to not cancel any lines of credit or reduce them. And you'll apply the same methodology in terms of computing EBITDA, which we were talking about, and certify that you are eligible to participate in this in light of conflicts of interest prohibition. So I think there's going to be some more guidance associated with that as well, but we'll see when the actual program gets launched. On top of the lender requirements, the borrowers have requirements as well, essentially listed here: refrain from repaying the principal balance of any debt until the loans are repaid. So they have to take priority as well, although under the priority loan facility, the eligible borrower may refinance an existing debt to a lender that is not the eligible lender. So they can refi under this program, it's just not if they're borrowing from you. Similar requirement not to seek to reduce or cancel any lines of credit. And you'll see here, certify that you have a reasonable basis that you'll be able to meet, this being the borrower, will be able to meet financial obligations for at least 90 days and does not expect to file bankruptcy during that period. So one of the conditions was essentially being strong prior to the onset of this unfortunate pandemic. So that's something that they wanted to keep in there as well, although they have loosened the requirement a little bit. Continuing on, you must also, the borrower, commit to follow compensation, stock repurchase, and capital distribution requirements. This was basically saying that while the loans were outstanding, you couldn't repurchase equity or make capital distributions, but they've loosened that a little bit in terms of tax distributions for S Corp or other pass-through entities, and compensation limitations basically for certain high-paid individuals making between $425,000 and $3 million. Their comp will essentially be frozen, and people making in excess of $3 million will potentially face a compensation hit while these loans are outstanding. And lastly, required to certify that there's no conflict of interest prohibitions. And 4019B of the CARES Act points back to 4003 for those who want to read it, but basically just saying that you're not conflicted from participating in this program, borrower and lender, for other types of issues that may preclude you normally from loaning money to borrowers or similar situations. So that's something to keep in mind. Now I'm going to turn it over. We're going to talk about, shift gears again to the PPP here, and specifically touch upon the certification requirements, which I have no doubt you as bankers are facing a lot of information on. So Josh, I'm going to turn it over to you.
Hey, thanks, Steve. Good afternoon, everybody. So yeah, as Steve said, we thought we were out of the woods. I'm sure you thought as well with respect to the PPP application process. However, looks like things may be getting a little bit more exciting before they get not exciting. So in true, government fashion, they try to do something that they believe is right for the people, provide, in there, you call it free money to allow businesses to basically maintain the way they are. And then they come around with this. So we're going to talk about, I'm sure your clients are asking you about FAQ 31. So we're going to talk briefly about it now. So when businesses, individuals, whoever it was, submitted the application, they signed off on the certification that said, the uncertainty of the current economic conditions makes necessary the loan request to support the ongoing operations. This certification was later clarified, and the borrowers must make the above certification in good faith, taking into account, in addition to above, the current business activity and their ability to access other sources of liquidity sufficient to support their ongoing operations in a manner that is not significantly detrimental to the business. Specifically within that FAQ, it makes reference to public enterprises, specifically those with substantial market value and access to capital markets. So okay, public companies, we know the Ruth's Chris of the world, the Shake Shacks, shame on them. They should not have applied. They gave their money back, but hold your horses. The SBA decides to come back on April 28th. The FAQ 31 came out on April 23rd and say businesses owned by private companies must consider these stipulations as well. What does a business owned by a private company looks like? Could it be a company just owned by private equity? Could it be a client like ours that are family owned, privately held? They're not specific with respect to what they mean, but we believe they mean everybody. Okay, so then from there, Treasury Secretary Mnuchin comes out on April 28th and says that loans of at least $2 million will be reviewed, if seen audited by the SBA, not by the bank. A lot of folks, we've gotten a lot of questions. When are these audits going to take place? Do you know what's involved? Do you know what we're going to have to provide? And the answer is no, we're not sure. There is the possibility that, the SBA will pick off the biggest loans first and work their way down. It's also very possible that, they're going to play Monday morning quarterback when they do this as well and look backwards and challenge your intent as to why you took the loan in the first place. So there's a lot of questions. There's a lot of uncertainty. There's a lot of agita surrounding what's included in these reviews, these audits, but they will be done by the SBA. What the FAQs also have done is recuse the lenders of, of really any kind of wrongdoing in this. If there does turn out to be, that the borrower was aggressive with what they applied for forgiveness, or just whether or not the intent was there to, and they should have applied in the first place, they're going to be able to point the finger solely back to the borrower. So what did they do? They said any borrower that applied for a PPP loan prior to April 23rd, 2020, and repays the loan in full by May 7th, 2020, will be deemed by the SBA to have made the required certification in good faith. So no harm, no foul. But, we're certainly having a lot of conversations surrounding this with our clients and our prospects, and we're going to talk to you in a minute about what it is we recommend. But the other thing specifically that they've said is that if you do keep the loan, there's certainly, and you shouldn't have, there will definitely be penalties, both civil and potentially criminal. If the SBA determines that there was blatant disregard. There's big numbers being thrown around, but to this point, nothing has been defined. Okay, so when we're having these conversations with respect to whether or not, companies should keep the loan, not keep the loan, if it's determined that they are going to keep the loan, we think it's very important for them to document the reasons to support the PPP eligibility. Now this support is not necessary with respect to, resubmitting the application at the 8-week period to the banks, but in the event that the SBA does at some point challenge the big loans, challenge the small loans, we want to make sure folks, have all their ducks in a row. So, some of the things we're asking them to document and memorialize are, whether or not they have access to capital outside the PPP. If you remember in FAQ 31, it specifically said, ability to access other sources of liquidity. So what are we talking about? We're talking about a line of credit, that's untapped, significant cash reserves in the business, other capital resources, right? So if you're a big company, you have the ability to, issue additional shares, sell debt. I mean, things not, necessarily that our companies can do, issue debt, but, that is out there, certainly. Another one is your business open, right? Certainly living and operating in the metropolitan area, businesses may be open if they've been deemed essential, but certainly working at a very low capacity. It's as if, yes, are you operating with a reduced staff? Did you have a decline in current sales and/or a cancellation of future orders? Just, clients who we've spoken to are experiencing reductions in sales of 50, 60%. This is having a dramatic effect on their business. We work with several, clients who sell directly into the retail market. Those businesses are getting really hurt because, as we all know, those stores are not open. There's no expectation or timeline when they will open. So any orders that they might have placed, they're canceling. And then to piggyback off that, so, have your receivable collections decreased, and/or have your customers requested more favorable payment terms? Sticking with the retail example, the Targets, the Home Goods of the world, they're, typically 30-day payers. Well, now they're 90-day payers, and really you have no ability to negotiate. So I would guarantee that 99% of your customers are having issues with collections, and/or having customers who are asking for, longer payment terms. Supply chain issues. So I work, 100% of the time in the manufacturing and distribution space. There still is a severe lag time on orders that are coming from overseas, 3 months, 6 months, depending upon where the goods are coming from. And those who are fortunate enough to have product here may not be able to deliver that product because their customers are not open. And also too, they may have issues with respect to, a reduced labor market. At the onset of this, there was many furloughs, there was many terminations just because of the tremendous amount of uncertainty that was going on. And now if you try to go back and rehire some of those people, you may have an issue because it's been well documented that, for your, busy bee workers, there's a good possibility that they will make more money on unemployment than they will, earning a paycheck. So a lot of folks are very inclined right now to sit at home. And then also too, I think a very good judgment is, are your customers or vendors applying for the PPP funding as well? So, a lot of our customers, clients, they B2B with each other, and it is very possible that they're struggling as well. Okay. So what are we? Like I said, we're encouraging all businesses who have applied or plan to apply for the PPP loan to document their rationale as to why the loan is necessary to support these ongoing operations. Also, too, we are telling them to prepare a cash flow, 30, 60, 90 days, to really project out where the cash is in order to show that in the event, if they didn't have this money, then potentially the money would run out, and that this loan is necessary for them to, continue their business. And again, like loss of income, slowdown of receivable collections, lack of currently available credit facilities. So it's one thing to have a line of credit, it's another thing to need more. And how are you going to access that money? So it's PPP, it's EIDL. Steve mentioned with the Main Street programs, those are not taken off yet, so you can't even apply for those. So where's the money going to come from? Potential of employee layoffs, furloughs, things like that. All these things support why you would need a loan. And then another thing too, we are recommending that time stamping this information, these memos, these documents is so important because we're making decisions today based on where we think the business is going to go. This is going to be much different than what the SBA is going to do 2, 3, 4, 5, 6 months later when they look backwards. So we're going, forward, they're going to go backwards. So that's why it's even more important. And there should be, approval as to these plans, whether it be top level management, if you just have an owner, or if you have a board of directors, they should all certainly weigh in on this as well. And then the other thing too is keep in mind, interactions with other FQs. Things are constantly changing, being updated, and you make sure that you stick to that. So definitely, some of them are able to get the loans, and for those of us who do not give them back, we want to know how those loans are going to be eligible for forgiveness. Turn it over to Todd, who's going to take you through how forgiveness is calculated, and hopefully those who really need that money can keep that money. Go ahead, Todd.
Thanks, Josh. Okay, we're going to talk about loan forgiveness. This was a very hot topic. It still is a hot topic, although we're really focusing a lot on whether or not the money should be given back by Thursday. But let's talk about loan forgiveness if it is applicable, which is one of the reasons why most people did apply for this PPP loan and what the general rules are. First, you need to know that the SBA as clarification of forgiveness is expected via additional guidance. That guidance has not really come out fully yet. You need to know that payroll costs include compensation of employees whose principal place of residence is the great United States of America. and it constitutes wages, salaries, commissions, or other compensation, payment of vacation, parental, family, medical, or sick leave, allowance for separation or dismissal, payment for provision of employee benefits consisting of group health care coverage, including insurance premiums, retirement, payment of state and local taxes assessed on employees' compensation. And per the SBA interim final rule, not more than 25% of the loan forgiveness may be attributable to non-payroll costs. So what is the non-payroll costs, the 25%? First, those are payments that are over the 8-week period following the date of the loan, consisting of payments on interest on mortgage obligations incurred before February 15th, 2020, rent payments on leases entered into prior to February 15th, 2020, and or utility payments under service agreements entered into prior to February 15th, 2020. And note that utilities include payments for electricity, gas, water, transportation, telephone, or internet access. So note that there are certain things that are going to decrease the loan forgiveness. Two parts of this. First is your head count decrease. The loan amount eligible for forgiveness may be reduced but not increased by the following two-part formula. Part one, the average number of full-time equivalent employees during the 8-week period, beginning with the date of the origination of the loan. Part B, the average number at the borrower's discretion of the full-time equivalent employees from February 15th, 2019, June 30th, 2019, or at your discretion, January 1st, 2020 through February 29th, 2020, and that is actually applied to the Paycheck Protection Program loan used for eligible costs. So the formula is A divided by B multiplied by C. But then we don't stop there. We continue to go on, because if there is a salary decrease, it will also impact the amount of loan forgiveness. Loan amounts eligible for forgiveness may be reduced by decreases in salaries and wages of any employee if the decrease occurs during the 8-week period, beginning with the date of the origination on the loan, and the decrease is in excess of 25% of the total salary or wages of the employee during the most recent full quarter during which the employee was employed prior to the commencement of the 8-week period. Note that employees who received annualized wages or salaries in excess of $100,000 are excluded from this calculation. But yet there is a reprieval. Yes, there's exemptions from reductions. During the period from February 15th, 2020 through April 26, 2020, if there is a workforce or salary reduction that meets the criteria on the earlier slides, but if the borrower restores the FTE employees to pre-February 15th, 2020 amounts by June 30th, 2020, and or the borrower restores the reduced salaries or wages for the employees to the pre-February 15th, 2020 amounts by June 30th, 2020, there is a reprieval. And of course, there's documentation requirements. Now, these documentation requirements are actually written out in the CARES Act and some of the FAQs, but it's possible that the banks will require even more. But here's what we know so far. For documentation requirements, the number of FTE employees on payroll and pay rates, payroll tax filings with the Internal Revenue Service, state income, payroll, and unemployment filings, canceled checks, payment receipts, transcripts of accounts, or other documents verifying payments on covered mortgage obligations, covered lease obligations, and covered utility payments, independent contractors and sole proprietors, see the following slides, certification from an authorized representative that the documentation presented is true and correct, and the amount for which forgiveness is requested was used to retain employees or make interest payments on mortgage obligations, rent obligations, and or utility payments enforced prior to February 15th, 2020. And we're told, according to the law, that the lenders will have 60 days from the receipt of the documentation to render their decision, forgiven or not forgiven. Continuing as far as the documentation requirements, self-employed eligibility, filed or will a 2019 Schedule C profit or loss from business operating as of February 15th, 2020, must plan to file Schedule C with the 2020 tax return. If there are employees on the payroll, Form 941, state quarterly wage unemployment tax reporting forms, and evidence of retirement and health insurance contributions. The owner compensation loan forgiveness is limited to 8 weeks of the 2019 profits, and the documentation for the PPP application requirements, 2019 Schedule C, 2019 Form 1099 miscellaneous, invoice, bank statements or book of records, 2020 invoice bank statement of book of records, and February 15th, 2020 payroll statement or similar documentation if applicable. That was a mouthful. So now, just so you know, there are still open questions. Yes, you are correct. There are still things that the SBA has not made clear. In fact, there's a whole lot of wonderful things if you want to go on the internet and read this stuff. A lot of people are in disagreement as to what actually things mean. But here's a few things to consider. Will the 8-week period be extended? Are the costs for the 8-week period to be determined on a cash basis or an accrual basis? At least 75% of the loan proceeds shall be used for payroll costs. What happens if the borrower spends less than 75%? Should full year bonuses and or year-end profit sharing contributions be included in the forgiveness calculation? Does rent cover only costs for facilities, or do equipment rentals count as rent for forgiveness purposes? And how is the full-time equivalent calculated? And how are non-COVID-19 reductions in workforce and or salary treated for purposes of the loan forgiveness reduction? Will the formula for salary reduction be on a prorated adjusted? Do the exceptions for the headcount and or salary reduction allow for a replacement of a terminated employer? So the following questions are unclear, as it's noted at the head of the slide, and there still needs to be further guidance from the SBA, such as what types of transportation costs qualify as utility costs? For employees rehired by June 30th, is there a time period for which they need to be employed in order to count towards the headcount salary restoration? In other words, can you fire them on July 1st? Will the expenses associated with the forgiven funds give rise to a tax deduction? Now we know per IRS notice 2020-32 issued on April 30th, 2020, expenses are not tax deductible. Will that be reversed? And will the forgiven funds be tax exempt for state tax purposes, depending on your state? It's not clear yet. So now I'm going to turn this open to my good friend Josh, who's going to have some other items to discuss with you good old bankers. Josh, take it away.
Hey, thanks, Todd. So as you can imagine, I still say to this day, my phone is smoking 24 hours a day because the phone rings, clients call, prospects call, bankers call, attorneys call. So as you can imagine, there's been a lot of discussion surrounding the application process, the forgiveness process. So we wanted just, to give you folks in the banking community, just some of the feedback that we've heard, regarding the application process. There are some banks who will have clients for life, and there will be, some banks who, may be looking to get rid of clients, find new clients. We do feel there will be a lot of movement after this process, as I'm sure you will are thinking as well. So again, this is just some of the feedback. One, clients some are certainly exhausted, from the process. There was a lot of back and forth, a lot of information that was needed through the application process. For those who went specifically through online, as you know, there were definitely some hiccups with getting the applications up and running in some cases. And for those clients who weren't fortunate enough to have a loan officer, in many cases they had to rely on some other people in the bank to answer questions who may not have been as knowledgeable about them and their business, and it certainly made it difficult. Another one too, a lot of times, and again, this may just be the way that the program is running, is that clients would ask questions with respect to the applications, and a lot of the feedback was go back to your accountant and attorney and discuss with them, and that may have been the way it was designed. But certainly there was some frustration there. From our standpoint, we could definitely say, and I could confidently say this, that there was really not any consistency between the banks on what costs were included in the payroll cost computation. Some banks included 1099s, some did not. Some allowed folks to include, if they had active general partners in a partnership, some allowed them to include that compensation, some did not. In the event that the business was a Schedule C with no payroll, some of the banks were accepting of those applications. Some couldn't wrap their hands around it because they were only looking for payroll and there was no payroll that existed. And another one just that kind of shocked the firm a little bit was, there was one bank in particular, we saw some emails today that, was asking clients for an additional certification that was outside the scope of what the SBA intended. So as you can imagine, there's a lot of uneasiness surrounding this, but I think that just made it a little bit more uneasy. So, are we coming from a point where things are super negative? No, but fortunately for everybody, there's definitely a way for us, for you to redeem yourselves if you think you might have had a bad experience with a client during this process. And again, may not be your fault at all, but it was a quick process that was forced into a really tight window. There was a lot of angst, a lot of anxiety, and it was certainly very stressful for everybody. So what are we doing as a firm? What can you do as an advisor? We're looking at this from an advisory practice standpoint. So we're saying start calling your business clients right now to discuss the challenges raised by the coronavirus. Talk about best, leadership practices, the applicability of, material adverse effect or force majeure meaning unforeseeable circumstances that would prevent someone from fulfilling a contract. So maybe they were involved in an M&A proceeding before this happened, or other commercial contracts. There may be ways to get out of them. Proactively reviewing loan agreements. Maybe there were very tight covenants in place prior to that, and maybe there's a way to restructure them, to make sure that clients can continue with the bank. Reviewing commercial insurance policies to understand what coverage is available. There's a lot of play out there with what potentially might be covered, under business interruption. We're still not sure. For clients, it's important for them to understand, which vendors and customers are most likely to be negatively impacted, and making decisions to protect their supply chain and the collectability of accounts receivable. We're spending a lot of time, before the pandemic and now during, to really do a lot of B2B, introduce clients to one another. There's opportunities for them to do business with each other and, try and help everybody through. Steve discussed before, but certainly navigating across employment issues, working from home policies. A lot of the payroll companies have been very helpful with that. Those who are attached to PEOs with HR departments, but not everybody, unfortunately, has access to that. Next one, just again, helping to ensure that HIPAA and other privacy concerns are being addressed. In some cases, restructuring real estate leases, understanding the immediate impact of new legislation and how to access governmental support. For those of you who have been with us for the last 5 weeks, we have, eat, slept, and I don't even know what else you call it, but this, the PPP, the EIDL, the Main Street, this has been our life for the last 5 weeks, and really committing to put the right education out there, essentially for the community, because we've certainly touched a lot more than just our clients. Going back to what I was talking about before with the cash flow modeling, making smart projections and being realistic, right? I think we all want to think that our business is going to bounce back and we're going to do great, but a lot of that is dependent upon the economy, and whether we want to face reality or not, we're still in the worst part of the country. So while everybody is getting back to work and business is up and running in certain parts of the country, they're just not here. Reviewing loan covenants and lining up bridge financing if necessary. It may be very difficult to get a loan done during the next 4 to 8 weeks, just because there's so much attention, that's being focused on this. The question really is whether or not people are even lending. And then, still focusing on what, the workforce should look like, employee headcount, shifts. Fortunately for those of us who are able to get this loan and keep this loan, it only covers 8 weeks. So what happens after that? So those are all things that we're, for us, being accountants, it's not just the tax returns and the financial statements. This is what's going to, help us keep our clients in business and help hopefully to keep clients, as Sachs clients forever. So there's no reason why you folks can't do the same thing to keep these customers with your banks. And finally, I'll say this, we've been very involved through the process. We do have an advisory service at the firm that will help, clients, prospects, your customers go through and track the expenses on a weekly basis, calculate forgiveness, and also too to have weekly conversations and updates as to what's happening, and be able to consult as to the changes in the SBA guidelines and how that impacts clients specifically. So you could certainly go to our website. There's a lot more information there. You can contact Todd, myself, Steve. We're absolutely happy to talk about it with you. So we want to thank everybody for their time today. We wanted, as Todd had mentioned in the beginning, we wanted to be able to reach out to you folks, who are on the front lines with this just as much as we are, let you know what we're seeing, provide you with some guidance as to what's out there currently and what's changing, and try and, give you a little bit to kind of go back and continue to add that value and be that #1 advisor to your clients, just like we hopefully are with our clients. We have developed on our website the COVID-19 Resource Center. So if you go to Sachs LLP, you'll see the button right at the top of the website. We encourage everybody to submit questions. It not only helps us create these webinars, but also to put FAQs back out there for the community as well. So if you do have questions or you have inquiries about the program, if you don't have a direct contact to Sachs, please email COVID-19@sacsllp.com. And we've been doing, for those of you who haven't listened yet, we do a webinar every Thursday at 10 a.m., updating everybody on what's been changing out there with respect to forgiveness, new loan opportunities, new FAQs, anything and everything that we're hearing. So tune in 10 a.m. this Thursday. And with that, like I said, we thank you very much for your time, and we will talk to you all very soon. Take care and be safe. Thank you.